Good afternoon, and welcome to Home Buying 101, presented by Town Bank Mortgage. Before we begin, I would like to go over a few housekeeping rules. I would like to invite you to open your chat and Q&A windows, which are located at the bottom of the Zoom screen, and a diagram has been presented for you. During this webinar, you will have if you have any questions for the panelists, please type them in the Q&A window only, and they will be answered throughout the conversation. The chat window will only be used and available for our team to communicate with you. And at this time, I would like to turn it over to my co-host, Linda Johnson.
Good afternoon, and welcome to the Charlotte Post Home Buying 101, What You Need to Know Before You Buy, sponsored by Town Bank Mortgage. We'd like to welcome everyone to this seminar this afternoon. We have Shervin Joseph, Diversity Outreach and Loan Officer with Fitzgerald Financial Group, a division of Town Bank Mortgage. Sean Higgins with United One, your mortgage process partner. And Yvonne Almond, Executive Vice President, Community Financial Engagement Officer for Town Bank Mortgage. Welcome to Home Buying 101, What You Need to Know Before You Buy. And at this time, we'd like to turn it over to Shervin Joseph. Thank you.
Thank you, Linda. Appreciate it. And I'm happy to be here. I think it's an honor and a privilege for us to present to your audience. I'd like to thank Gerald Johnson and Linda as well for giving us an invitation to provide any kind of knowledge we could provide, which is any literacy training we could provide to assist people in purchasing homes. That's how you start with the wealth and reducing the variance between white, black, brown folks. And I'll get into more in my presentation. However, just want to introduce a couple of the panelists. Yvonne Almond will be involved, as well as Sean Higgins. Sean Higgins will go first. He'll present first. He's going to do about 20 minutes, and it's everything you want to know about credit. He's a senior vice president with United One Bank, and it's been my privilege, and I've done 15 years of seminars with Sean, so I know no one knows credit better, and I'm honored and happy for him to be here. Sean, you're up, bud.
Thank you, Shervin. Thanks very much, everyone, for having me today. It is an honor and a privilege for me today as well. I'm going to share my screen. Bear with me 1 minute. Okay. Everyone can see my credit scoring presentation?
Yes.
Okay, beautiful. Okay. So my contact information is there for everyone. Sean Higgins, United One Resource. A little bit about me. I've been in this business for 30 years. As Shervin has said, I've been fortunate to be working with him for about the last 15. A couple of things I'd like to let you know up front about my company is I'm not a credit repairer. I work with lenders. You'll hear me say a couple of times throughout the presentation that the best place to get the information on where your credit reporting stands is to start off with a lender and be aware of credit repair clinics. There's a lot of them out there that tend to prey upon people, but we are a credit reporting agency. We've been in business since 1918, and we only work directly with lenders. My goal for today is to provide you with a lot of information on how credit scoring works, a little bit about how much of an impact that can have in the mortgage process, and do the best that I possibly can to hopefully reach a few people and help them improve their credit scores. So next slide. What is credit scoring? Obviously, a credit score it's a measure of the likelihood of someone to pay their debt. The most prevalent credit score that's used in mortgages is the FICO score version 8. It has a range that exists from 300 to 850. I'm going to spend some time talking about the different types of credit scores that are out there. But for today's purposes, what I want to educate you on is the FICO score version 8. That's what's used in mortgage lending. Why is it important? As Shervin will tell you in a few minutes, it's one of the most significant factors when it comes to being approved for a mortgage. It has a lot to do with the price of the mortgage and the interest rates that you'll pay. It's a very, very important thing. When I got into this business in 1992, no one really understood credit scores. Now I pretty much can tell you that credit scoring, once I explain to people what I do for a living, it comes up at least once a week. People are very, very well versed in credit scoring. And my goal is to provide you with some more additional information on actually how that's viewed through the mortgage side. So as I said, the score ranges are about 300 to 850. Where my company comes in is we provide the credit reports to the lender. And then what we also do is we work with the lender on improving credit scores. We usually work in those ranges that you see there at about 3 o'clock, 580 to 669 and 670 to 739. What we have is we have a tool that's a score simulator that helps the lenders decipher the credit scores, if you would, and see what kind of actions could be taken to improve the credit scores. I'm going to take some of those things, and I'm going to show you on the screen throughout the rest of my presentation. So where does it all start? People ask often, what has the biggest impact on a credit score? And obviously, it's your ability to repay your debts. So payments is the biggest factor to credit scores. Second biggest factor is balances to limits. You'll hear the term utilization. Utilization rates on credit scoring, utilization rates on balances on revolving debts is a very, very significant part of the credit score. A little bit lesser is going to be the length of the history. Inquiries, there's a big misnomer out there that inquiries have a lot to do with credit scoring. I'm going to talk to you a little bit about that. And the least impact on a credit score is going to be the types of credit. So to summarize this, once again, it's your payments, it's utilization, length of history, and then to a lesser extent, inquiries and types of credit. Obviously, an inquiry is when someone is given the permission to inquire on your credit file. Most consumers have a credit file with each of the credit reporting agencies, which are Experian, Equifax, and TransUnion. Generally speaking, someone cannot look at your credit file without you giving them permission. You will see when you do review your credit report, it'll list who's actually made inquiries on your credit file. That's a good thing to keep track of, to make sure that there's someone that should not have access to your credit is actually viewing it. As I said before, inquiries, small impact. The way that the credit scoring people have gotten pretty sharp, and what they've said is if you go out and shop for a similar type of similar purpose within a 2-week to 1 month period, they're going to lump all those inquiries together and view them as one. So if you were to go out into the market and make an application for a mortgage with a lender, generally speaking, what happens is about 30 days after that inquiry has been made, your credit score will be impacted by about 5 points. Not a real lot. If you're out shopping for cars and the dealer takes you through Ford's plan or Toyota's plan, whatever it may be, as long as those are within that 14 to 30-day window, they do not have much of an impact at all on your credit score. So inquiries, they're probably one of the things that you should worry the least about in the credit scoring process. As I said, the 30-day period, FICO scores, really, if you want to improve your scores, pay your bills on time. Keep your balances low on your credit cards, and spend the time being vigilant and focused on your credit score. And get into a little bit more detail here as far as how you can actually improve your score. So this will be a little bit of a view from where I sit and what I see. So if you have a revolving account and say there was a recent late on it, it's a good plan and a good practice to negotiate with your creditors. We see a lot of times when people make mistakes and maybe don't pay a bill on time, and it may have been an oversight. You'd be surprised, a lot of times those credit grantors, credit card companies, are willing to waive that one-time late. But it's all about, you know, standing up for yourself and reaching out and asking for that. And it happens quite a bit. If there's a collection account on your credit report, collection, I always tell people that collection agencies are salespeople too. And if you reach out to that collection agency and you make a counter to pay that collection account off, but only in exchange for removal from your credit report, it'll happen quite a bit. There's nothing that bothers me more than when I look at a credit report and I see someone has a $127 balance from a dentist or something like that, and it's being reported as a recent collection account on your credit report, and it's driven your score down by about 100 points. To me, that's totally unfair. So you have to reach out to the collection agency, make an offer to pay them, because they're there to get paid, and see if they'll actually remove it from your credit report. That happens quite a bit. One of the things that we see the most of is if you can get your revolving debt balance below 20% of the limit, that's the utilization I was speaking about a few minutes ago. That's going to have a significant improvement in your credit score. Sometimes if cash is tight, you can move balances around between different revolving accounts. But this one right here, besides the collection agencies and besides removing the lates, this is the most common thing. When we look at a credit file, we'll often see someone's up over 50, 60, 70% of their available credit, and that's going to have a pretty significant impact on your credit score. Student loans, which Shervin could explain a lot better than I can, as far as how they're handled in the mortgage process. We see a lot of issues with student loans. And what we see is different consumers may have a deferment on their student loan account, and the student loan servicer is not handling that right. That's something that we see every single day. It's
Hey,
really
Sean?
up to the, yes, sir.
I'm sorry, your slides wasn't matching up with your topic with student loans.
Oh, I'm so sorry.
That's all right.
Top 5 ways that you're all seeing the top 5 ways to increase scores, correct?
No,
I'm sorry. I'm having a bit of an issue with my computer. What are you seeing right now?
what is credit scoring?
It hasn't advanced from your first screen.
I'm so sorry. How about now? No,
Now you're good.
I apologize. I'm sorry. It was advancing on my side. So the top 5 ways, you see the screen now, that's just the top 5 ways to increase the credit scores. As I was discussing on student loans, there's a lot of times where the student loan servicer is not, in fact, reporting that properly. That's a big issue that we see quite a bit. Installment loans have very, very minimal impact in credit scoring. Just go back to the top since I was a little bit delinquent with my slides here. Obviously, I explained to you about if there's an issue with a late payment, you can negotiate with your creditor to get that removed. The collection agency, obviously you want to talk to them about paying it off and having it removed from the credit file. And then finally, the revolving debt utilization. If you can get that below 20%, I'm sorry, that's going to be the one that's going to have the biggest impact on the score of the items that I've listed here. Top 5 factors that are driving your scores down. And we're going to see recent lates, accounts that are showing currently showing past due. Anything above 30% is going to have, I'm sorry, 20% is going to have an impact on your credit score. Any unpaid and recent public record information. And quite honestly, sometimes you'll see people that don't have any open or active trade lines. That's going to have an impact on your score as well. It seems that a lot of America has the FICO score, I'm sorry, has the Credit Karma score. We see a lot of that. And I know in the lending business, a lot of consumers show up with their Credit Karma score, whereas the mortgage lender is going to use the FICO score version 8. And there's some differences. You're going to see that in the mortgage industry, they'll only accept the FICO 8, whereas the Credit Karma score is not accepted. They do have the same score ranges. FICO uses all 3 bureaus. Credit Karma only uses 2 of the 3. And FICO is very tight around what they actually accept into their calculations, whereas Credit Karma's is a little bit more loose. FICO score will not accept renter utility bills in their score model, whereas Credit Karma will. So what we see is the Credit Karma score tends to be about 20 to 30 points higher. So when a mortgage lender will sit down and talk to a consumer, they're going to have to reconcile the differences between those two scores. And this is a good illustration of why it actually happens. It's different. It's the same credit data, but it's a different scoring model. And there's been trillions and trillions of dollars of mortgage loans portfolios that Fannie Mae and Freddie Mac have had out there for many, many years that have been performing very well on the FICO score A. Experian Boost is something else I like to talk about. It's very common. It's very prevalent. You've seen this a lot on.
Hey, Sean,
Yes,
excuse
sir.
me a minute. Yvonne had a question.
Yes, I just put it in the chat and it's about settling your debt with creditors. Will that trigger the issuance of a 1099-C so that you will have problems with the IRS if you settle a debt with the creditor?
I believe that, yes, when you do settle a debt for less than the balance, you're probably going to receive a 1099 from the credit grantor. And you will have to take that into consideration in a lot of your negotiations and your calculations for what you need to come up with. Yes.
But it doesn't, with regards to settling a debt and how it would affect your ability to acquire a mortgage, you will be able to settle a debt as long as you have the documentation to support that it was settled in full. And as long as you have something on letterhead from the creditor, because it's going to probably be a third-party collection agency that you settle the debt with, or even the primary creditor. But you just need to have that, so then when I send it to Sean's company to have them update your credit report, and they check with the credit bureau to ensure all three reporting agencies have it squared away, we have the documentation. Without the documentation, more than likely that stays on there and will have an effect on your score.
Yeah, very well put, Shervin. Generally speaking, if you could get that credit collection agency to actually agree to remove that trade line, that's the best possible circumstance. Okay, I move on to Experian Boost. Experian Boost is they spend a lot of money advertising right now. And what Experian Boost does is it helps people build a credit report. However, in the mortgage process, Experian Boost does not have an impact on the mortgage score. It's only going to report on the Experian file only. It generally shows up as a self-reported utility or cell phone. We've even seen Netflix account $15 reported. Sometimes it presents an issue in underwriting on the mortgage side. When we see it, we advise our mortgage lenders that it does not have an impact on the score for mortgage. And usually what ends up happening is the consumer could actually remove the trade line by logging into their Experian Boost account, and it'll fall right off immediately. Something new, rental information considered in mortgage lending. Rentals have, they have a place in the mortgage process, as Shervin will explain. But Fannie Mae came out in September and said that they're going to consider rental payments in the mortgage decision process. What they won't do is it will not have an impact on the credit score. So it's something that has an impact in the Fannie Mae decision process, but it's not going to improve a credit score. There is some misinformation that exists out there about that. I could see Mr. Johnson has his hand raised.
Yes, let me just ask a quick question. In terms of the FICO score, how does that translate into actual interest rate charges that's going to be put on? If I'm buying something and there's a, let's say 5 or 10 difference between me and somebody else trying to get the same purchase, how does that translate in terms of the interest rate that I'm going to be charged with a better score than someone that has a worse score? That makes sense.
Yes, sir.
That's a great question. And the translation is, if you have, for instance, a 620 to 660 or 680, you're pretty much in one range. The higher you go, obviously, with your FICO score, the better rate that you're going to acquire. So if you're at 800 or 740, 760, you're going to get a phenomenal rate. Now, what does that mean? Let's put it in basic terms. With the market where it is today, instead of getting a 3.75% rate, you would probably get a 4.25%. It's always going to be about 0.5% higher, because the better score is going to get the better rate. That's why it's absolutely critical that folks focus on taking care of their credit. When you have credit scores around 640, 660, and you're playing right there on the borderline of just barely qualifying, the minimum score that we accept is 620. So when you're at 640, 660, yes, you'll get a score. We're pretty aggressive as far as rates are concerned, and you'll get a decent rate. But if you really want a great rate, then you're looking at about 720 and above. And the higher you go with that score, 760, 780, 800, you'll find that your rate becomes even more attractive. And that could save you a ton of money on the monthly payments, and it'll save you a ton of money on the annual payments. That's why I can't stress the importance of credit. And that's why I always ask Sean to go first before we tie him in and tie the credit in with mortgages. It is absolutely critical that you focus on your credit and your FICO scores.
Thank you.
You're welcome, sir.
Okay, I'm just going to wrap up right now. Bit of information for you, some useful information. You can get a copy of your credit report from annualcreditreport.com. It's free. Everybody's entitled to a free copy of their credit report. That's how you get it. The 3 national credit reporting agencies, their contact information, telephone numbers, and their websites is listed as well. And then the last one is just opt-out pre-screen. That's a way to prevent the pre-approved offers from coming home and hopefully eliminate any fraud that may be out there, because sometimes those offers get into the hands of the wrong people, and you can end up with a little bit of a mess on your hands. So that's all I really had for today. I'm going to turn my screen back over.
Well, yeah, and Sean, with regards to the credit reporting agencies, is it difficult for a borrower, for a customer, for them to get something taken off? Experian, Equifax, TransUnion, is it difficult to get erroneous information off that could be adversely affecting their score?
No, not at all. There's a process that you'd have to go through with the credit reporting agencies. But if you have good, sound documentation, they have an obligation to clean that up within 30 days for you. That's their obligation under the Fair Credit Reporting Act.
Now, when you say that they have an obligation, what happens if they don't clean that up in 30 days?
I believe it's gonna fall off. If you file a dispute, the process is to go to the credit reporting agencies and file a dispute with your information on there and the documentation that you have. And that'll actually be the process that you have to take. But if they don't act within 30 days, it has to come off.
Got it. And how often can you get a free credit report?
You're entitled to it once a year. We usually advise people to do is to get each year credit files. So maybe every 4 months you want to go out and at the first time you get Equifax, second time get Experian, and the third time get TransUnion, so that you're aware of what's actually happening on your credit file throughout the year. There's no fee for that. They may try to entice you to buy a credit score, but I would not recommend that, because the credit score might be meaningless. Really, the best place, if you're in the home buying mode, the best place to go is to go to a lender first, make application, have your credit file pulled, and then move from there.
Thank you. Let me just remind folks that what Sean said at the beginning, that he's not a credit repair person. I'm not a big fan, and he knows this, of credit repair entities. I'm sure they have their place, and don't misunderstand what I'm saying. I just think that when you take $1,000 to pay an entity to do something that you could do for yourself, that is money that you could use to pay off or pay down debt, or even use towards your down payment and closing costs in purchasing a home. I just think way too much money is spent giving it to someone else or to an entity to do something that you're capable of doing for yourself. And really and truly, all you would have to do is follow up. So it's critical that you pay attention to this sort of stuff, because there are a lot of people that take predatory action against folks that really don't understand the process. And that is critical to the process for you and the kind of money you would spend just getting yourself, let's say that if you're borderline credit or if you're subpar credit. So just very important that you pay attention to that. Thanks, Sean. And if any other questions come up, we will certainly include you.
Let me ask you one more before we leave.
Mr. Johnson has a question.
Why do we need so many scoring companies? You had all the different ones. I know of 3 right offhand, but why do we need so many to score for companies?
Sean?
I had a hard time understanding, I'm sorry.
No, he said, why do we need so many reporting agencies? There's 3 that we know of right off the bat with Experian, TransUnion, and Equifax, and I'm sure that there's more. But why so many?
There's actually a 4th one out there, sir. And
really?
They're not recognized by Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac pretty much dictate that process as it relates to mortgage. The truth, sir, is they've been around now for probably each of them have been around for close to 60 or 70 years. And it's just always been the way it's been. I think the lenders like it because it keeps them honest and it creates competition. But there's really, it's just a business practice more than anything. It's not like it's a government requirement or anything like that. They're very, very tightly governed as far as what the compliance and the federal oversight that they get. But it's really just been, they've been in business for many, many years.
So then why if you use it all 3, you get different scores from all 3 of them, just based on that. So what's the criteria that is going to change the scoring for each?
Well, that's a good question. What is the criteria that would change the score for each? In other words, from our standpoint, a lending standpoint, we're always going to do the middle. And the question is accurate because, you know, we've seen this, Sean, where Experian might have one score, but Equifax will have another. And there's a disparity then with TransUnion. Could you explain why that is?
Sure. The biggest reason is timing differences because the credit grantors provide their data to each of the repositories, which is Experian, Equifax, and TransUnion. They report that data at different times in the month. So there's a disparity or an unevenness of the reporting. That's number 1. And number 2, sometimes you may see collections on one bureau and not another, and collections have a negative impact on a score. So usually, as it relates to the large national credit grantors, they're pretty consistent in reporting across all 3. And then mainly it's the collections you see on some and not others. But really it's a timing difference is what causes, if the files are all considered to be equal, it's a timing difference because they don't always hit at the same time.
But even when they don't hit at the same time, that cluster sometimes is not similar. You know, like for instance, Equifax might have a 700. TransUnion might have a 680. And then all of a sudden, Experian will have a 620. The disparity is nuts and it drives us all crazy, but there's no rhyme or reason, and it's a matter of who reports what. Is there any other questions for Sean?
I had one. This is Yvonne again.
Yes.
On the lending side, I'm actually on the bank side. We look at the 3 agencies as Equifax, East Coast, Experian is typically used in the on the West Coast, and TransUnion is used in the Midwest. And on the bank side, when we pull our credit, we only use one of them, and it's generally Equifax that comes up for us. on the bank side.
Different kind of reporting from the bank side, from a business standpoint and from a mortgage lending standpoint,
Correct.
right? Right.
Correct.
All right, well, thank you. And if there are any other questions, we'll certainly get Sean to answer them, or we'll all answer your questions as we go along. Thanks, Sean, that was awesome as usual. I am going to share my screen so I could start my presentation. Hold on one second.
While you're doing that, Siobhan, we got a couple of questions in the Q&A.
Oh,
if
sure,
we wanna
shoot.
Address those.
Yes, that'll be nice while I work this.
And it seems to be for Sean. Someone asked, does paying your bills twice a month force the credit agencies to count multiple payments to help increase your score?
No, because they only report a balance once a month. So if you're hitting it twice, it's great. You're probably paying it off faster, but they only report it once a month.
And somebody else said they had 2 late payments in 2018. How do they get those removed? Or does that even make a difference?
Well, they'll age off. That's number one. So if there's really no avenue to get them removed, they will age off and become less of an impact as you move along. It's probably tough to, if it's 2 from the same credit grantor, it's probably tough to ask for forgiveness on that. If it was 1, but by and large, you know the answer to the question if you don't ask it, that's no. So you probably should make an inquiry and see what kind of results you can get. I would caution though, it's a little bit more difficult when there was 2 as opposed to 1.
And probably because they're old, they're probably not affecting the score as much now anyway, right?
That's right. That's right.
Thank you.
I'm having a little bit of issue, so if there was another question, go ahead and answer it. I'm not sure why all of a sudden I'm having this issue. Hold on.
I will talk about credit reporting agencies, credit repair companies. If you're coming for a commercial loan on the bank side, we don't look favorably on your financial statement if you've used one of those, because it shows that you may have some problems handling your bills, whether it's looked at, whether that's fair or not. That's how the lender is looking at it. So it does not help how you're viewed when you're applying for a business loan to have credit repair assistance on your credit report and your financial statement.
Yeah, the best place to go is start out with annualcreditreport.com. Get an idea of what's going on with your credit score. I tend to use the word fitness. And what I mean by that is you get a good feel for what's going on, and then you can get a feel for what things that you actually have to do to improve your score. It can be done. It's just a matter of just having a plan, sticking to it. And that's why I refer to it as fitness.
And you're better off, like the person that had the late pays in 2018 and they're current on everything and have been since, you're better off having that rather than having the credit repair company on there setting up payments.
You probably have more money in your pocket because a credit repair
Yes,
agency will
absolutely.
take money from you and really guarantee no results.
Yes.
I could see a comment from Janice. I found that Experian app, which is free, helps you stay on top of your credit score. That's true. The more knowledge there is, I'm very much a big proponent of Credit Karma. I actually have a Credit Karma account. The only thing I just like to warn people is the Credit Karma score is different. A lot of people will ask me at these presentations if in fact the score that I get from, like, I'm just paraphrasing what I may be asked. If the score that they get from their bank or something like that with their bank statement or their credit card statement, if that score is good, read the fine print. But once again, those scores they have an impact, and it's gonna show up as a different factor depending on the scoring model that's used. But they're great tools to use to get a good handle on where you actually stand. It looks like Shervin's, here he is. He's back. He's having this. I was having an issue. There he is.
He's good now.
You're good now, Shervin.
Yes.
Technology is great. Sometimes you have to sign off and some sign back on.
Great when it works.
You're muted.
All right, how's that?
Very good.
Okay, thank you. And my apologies to everyone. I'm not sure. I do at least 2 of these a week, and that one was a first, but there's a first for everything when you're in tech. So my apologies. First of all, just a quick background, and I don't want to get into too much about me because it's not about me, it's about you guys. I am Shervin Joseph. I am a diversity outreach manager, and I am a mortgage loan officer. I've been in the industry about 35 years. I've held just about every position in mortgage banking, division manager, area manager, and so forth. But the one position I cherish mostly, and I will continue that until I decide to end my career, is mortgage loan officer. Gives me a lot of satisfaction to introduce people to their keys and home ownership. And, you know, if I could help them in any way with education, pointing them in the right direction, getting them approved for a mortgage, that's what I believe we're here to serve, and that's what it's all about. I am also with Fitzgerald Financial, which is a division of Town Bank. So if you hear me say Fitzgerald Financial or anyone else, and that's one of the divisions of Town Bank. And I will say, and this is a shameless plug, that I am fortunate enough to be with one of the better companies in the country. The great thing about Town Bank is we were just named number 9 in the country by Forbes magazine out of the 100 performing banks. So I'm very full and a lot of pride when I say that. That's not an easy task to accomplish. So we have a lot of great people working here with the same servant mindset to take care of folks. Next slide, please. So why choose us? Next slide. Loans are tailored for your needs. You know, we are here. Once we meet with you, we will be able to put together a mortgage that fits you personally, whether it's a government loan, which is FHA or VA, or conventional loan. It just depends on your needs. Next. We are, as I said earlier, we're very aggressive as far as rates are concerned. But again, rates are tailored now in the industry to your credit profile. So that has a lot to do with it. Closing on time for us is not a problem. Matter of fact, Fitzgerald Financial is known for closing loans and setting the benchmark for other mortgage companies to close loans. We close loans. We have a program called the Platinum Program that if you provide the loan officer everything up front, we could close the loan within about a 2 to 3 week radius. Now, there's a lot of responsibility to you as the borrower to do that. But yes, we're in great position to help borrowers with closing quickly and different types of loans. Next. Thinking of buying a home? Next slide. Next. Rent or own? There really isn't any consideration, in my opinion, when it comes to this. You're renting. You have no control over the rent increases, although it might go up annually, but you're just paying somebody else's mortgage and it's getting away from you. When, you know, with tax deductions, there are none for renting. There's no privacy. And no, you can't personalize a space to your needs. Usually there are restrictions by the landlord. With owning, you're building equity. Then you're starting to experience what wealth is about. You have tax deductions you could claim. And yes, there are 0 down payment options, and there are only 2. And that's very important, and I'll come back to that later on. customize your home the way you feel. I mean, as it's your home. But here's the biggest deal. It's a fixed payment option. You get a fixed rate. You don't have to worry about your payment. You don't have to worry about it going up. And no, I'm not one of those people. And you have a choice when you meet a lender to let them know you're not interested in adjustable rate mortgages. I don't believe in it, particularly in the last 5 to 8 years. There's been no reason. The market has been great and interest rates are fixed caps. So you're in pretty darn good shape when you get that rate. Next slide, please. Are you ready to buy? These are questions that you have to ask yourself. Do you have steady income? Do you pay your bills on time, including your rent? Because all of this is going to be part of the process. Do you have low to medium debt? Do you have any money in savings? Do you have the ability to make the mortgage payments? Do you have okay to good credit? Next slide, please. The only way you find out about all those questions is the pre-approval process. In other words, asking yourself those questions and you providing the answers, usually the answer is, I don't know, I don't know. And it should be a truthful, I don't know. Not that I know I'm ready, I know I could buy this, or maybe I'm not. I think a lot of people underestimate their ability and sometimes overestimate because they just don't know. And that's the critical part of this process. And for that matter, for this presentation, so that you find out what is real and what is accurate. Realistic pursuit of properties, pre-approval. You know what to buy and you know what the realtor should be looking for. The realtor doesn't want to show you something at 400 or 500,000 when you could only afford 300,000. We need to know that. Any realtor is going to ask for a pre-approval letter first, and who the lender is, and have a candid conversation with the lender that this person's ready to purchase. Strengthening your buying power. When you're ready to make an offer, you have to present a pre-approval letter. Without that pre-approval letter, there's no offer being made. So at least you arm yourself with the tools necessary so that you could purchase and you could win an offer. In this market, winning the offer is just part of the battle. Understand the differences between what you qualify for and what you can really afford. Understand that just because you qualify on paper doesn't mean that you qualify, because we all know that we all have hidden debts, whether it's insurance, whether it's cable, the debts that don't show up on the credit report. Be honest and candid about your ability to afford what you're getting yourself into. Understand the loan programs and how to use them to leverage your purchase. Again, make the loan officer explain the programs and how it benefits you or how it doesn't help you at all. Review your credit for accuracy beforehand. We were just talking about credit with Sean. It is absolutely critical that you know your credit, know that your score is going to qualify you for a mortgage, and know that you're in pretty good shape as far as getting out there to purchase. But your credit is paramount in this endeavor. Obtain a yes or when answer to your application and not no. And that's how you get to that point, is with the pre-approval. The difference between what you qualify for and what you could really afford is absolutely crucial. Next slide, please. In qualifying factors in the 4 C's: capacity, credit, capital, and collateral. Income, capacity to repay the debt based on your earnings, your employment history, expenses, and number of dependents and other obligations. All of that is a factor. And that is a factor if you're looking at first-time home buying programs. That's even a heightened factor. Credit, always a factor. History of how much you owe, how often you borrow, if you pay your bills on time, and if you're living within your means. Absolutely critical. Assets, capital, or the amount of cash you have for your down payment, and settlement costs, as well as cash reserves to deal with repair or replacement expenses that might arise after you own the home. You can't just go into a home with just a bare amount to qualify. Matter of fact, most underwriters would like to see you have a couple of months in reserve that in case something happens, you're prepared. And you have to prepare for that in case anything happens. You can't just prepare, I need $10,000 hypothetically, and you know, that's all you have. Well, then what happens, you know, when you get into the home? There's moving, turning all the utilities on. There's a lot of stuff that happens that you have to be prepared for. Property, collateral to protect the lender's investment if you can't repay the loan. Your home you buy must be worth enough to back up your loan. And that's where the appraisal comes in. And that's why people, why do I have to pay for the appraisal? And people usually associate inspection, home inspection, with appraisal, two different things. Home inspection is to make sure you're getting a home that everything is functioning. The appraisal is to make sure that the value of the home is what the seller says it is, and that it's supported by the comparables in the neighborhood. So it's very important that you understand this. And again, the loan officer and the realtor could explain it, but you know what? Put the loan officer on the spot and make him or her explain that to you. Next slide, please. What factors affect your monthly payment? Next slide. Ask the lender for their current mortgage rates. Interest rates vary from lender to lender. They really shouldn't vary that much, but they do. As I said, we're pretty aggressive, so we stay close to what the market is. When you ask your lender about locking in, from my standpoint, and I can only speak to my standpoint, I can't speak for other lenders. When you first come in, there's not a matter of playing the market. That's foolishness. The rate is the rate. Look at the rate, and it's time to lock in. You can lock in for 30 days or 60 days. Do not sit there and someone inform you that, well, let's see where it goes next month. Let's see where it goes tomorrow or next week. You might come in and the rates might be 3 3/4, and next week it could be 4 1/4, 4 1/2, because somebody gave you the wrong information. Always find a loan officer with integrity, someone that you could trust. Okay, that is critical. Remember, Maya Angelou said, if people show you who they are the first time, believe them. So if you feel uncomfortable, get out of that situation and get somebody that you could trust. Origination or discount points are, you know, fees paid on the loan. A discount point or origination fee, one is 1% of your loan balance. So if you're buying a house that's $300,000, that's $3,000. I don't do loans with points. I rather offer you a loan with 0 points. And you should pose that question to any loan officer you see, because again, 1 point, think about that, $300,000, $3,000. That $3,000 could help you towards your closing costs. That $3,000 could help you with something else that's going on with getting in the house, or even after for your reserves. So don't spend money aimlessly because, you know, someone says, hey, I could give you this rate. Find out, shop them to make sure that you don't need to pay that with somebody else. Next slide, please. Some lenders require 20% of the purchase price as down payment. So I'm going to nip this in the bud. There's myths out there that put people at a disadvantage because they don't know the process. There's no really 20% down mortgages unless you're eliminating mortgage insurance. And that mortgage insurance protects the lender against anything happening to the property, a requirement on conventional loans. But it's not mandatory that you put 20%. FHA loans, which are government loans, minimum down is 3.5%. Conventional loans, minimum down is 3%. USDA and VA loan, next slide please, are zero down loans. Next slide, please. So which mortgage is right for you? So I was just talking about a conventional. Conventional loans are 3% down, typically 5% down. However, their guidelines are just a little bit more tighter, and the interest rate on a Fannie Mae, Freddie Mac, they govern conventional loans, are usually about 0.5% higher in the market than an FHA, which is a government loan, or a VA, which is a government loan. Next. A VA, if you've served in the military, you will have VA eligibility, and you have to make sure that you served enough time on active duty to make sure that you're qualified for 100% financing with no money down. Best loan there is if you've served. USDA is considered a rural loan, but you have to find out if the property is approved USDA. You could go on a particular street and you could think that you're not rural, right out on the outskirts of the suburbs, and one house is USDA approved and one house is not. That's just the way it's marked up. We look it up for you if you call and say, hey, is this house USDA approved? And it shouldn't be in the suburbs or in the city. It should be on the outskirts because it's usually in a rural area. But that is the only loan other than VA that is 100% loan, no money down. The renovation loans, that is a rehab loan. FHA offers a 203K and conventional offers a rehab, conventional rehab loan. Usually first-time home buyers, this is just totally my opinion. If you qualify for it, I would be more than happy to assist you. If someone else, if you go to another lender, make sure they explain to you that that's a very tedious and the process is a lot more task. It's just very tedious, and it takes a lot. You have to get the contractors approved. You have to get the packages yourself ready back and all signed and approved back to the lender. And so that's a process. And if you are looking for that kind of rehab property, usually take somebody that's experienced with ownership first, with a first go round. However, I've seen people get through it. I'm not a big fan of it being the first time around. I think you need some experience. Next slide, please.
Before you go, could you go into a little bit more detail about first-time home buyer? I think we've got a couple of questions, what it means. Can you have owned a home in the past?
Okay. Well, first-time home buyer, as Yvonne just said, usually you have not owned a home. Okay. Now, depends on your area and state, because you could have owned a home maybe about 3 to 5 years ago. And some states and counties will count that, hey, just because you owned it some years ago and it's been maybe 3 to 5 years since you own it, you're now considered a first-time home buyer again. So in that respect, yes. But if you own a home currently and you're looking to purchase another home, that's not considered a first-time home buyer. And the county will allow some kind of contribution and a discount for the first-time home buyer. I'll get into more to the first-time home buyer programs. I'm not going to go in exclusively, otherwise we'll be here all day, but I'll just mention that with the first-time home buyer programs, what they might offer in your respective county or states. With a conventional loan, as little as 3% down. Next. And you can run next all the way through so we could make sure we give these folks all that they need. Competitive rates, as I said, there's PMI, private mortgage insurance that protects the lender against anything happening to the property. Keep in mind that if you don't put 20% down, that is going to be a requirement. And I'll get to FHA and their mortgage insurance. Interest rate, loan program, and down payment options are driven by credit. Their credit is, again, scores are just a little tighter, and the requirements are a little bit stricter than FHA. Next. FHA down payment as low as 3.5%. You can use a gift from a family member, again, mother, father, sister, brother, to assist you in purchasing a home. Less strict on debt to income ratios. However, there are guidelines on all loans with debt to income ratios, but they're just a little bit less strict than conventional. Can be used towards home improvement, as we discussed before. So FHA gives you the most latitude in purchasing a home. And what does that mean? Well, let's say you have a 640 score, 630, 620, and everything is worked out as far as your credit, then that's probably the loan that you want to attack and embrace. The rate is always going to be 0.5% lower than conventional as a government loan. Next slide, please. The VA loan uniquely allows active duty reservists and veteran borrowers an opportunity to purchase a home with 0 down payment and 0 monthly mortgage insurance. In other words, the VA funding fee is rolled into the loan, and that guarantees you the opportunity to no money down requirement. So there's no really monthly mortgage insurance from the VA side. There's always monthly insurance to protect the house for yourself. Limitation on buyer's closing costs. There is, but the seller could pay just about all of your closing costs if worded correctly in the contract. So you could potentially, with a VA loan, write a contract, and if the seller pays your closing, come to closing with no money out of pocket. One of the few loans you could do that with. So that's for our veterans and active duty personnel. It's a lifetime benefit. If you use it once and you sold the property, you could use it again. Fun fact, if you use it once and there's equity, VA benefits left over, if you move to another area, you could use it again. It is only used for the purpose of primary residence. So you can't do an investor loan with a VA. You can't buy 2 VA properties in the same area. Next slide, please.
Can we answer, because we scheduled this for an hour, we will continue on, but some people might have to drop off because this is actually.
Oh yeah, no problem.
And I want to get these 2 questions answered. And Yvonne started one of them, but Angela Broadner asked the question that her daughter's a first-time home buyer, and she has 10K, and she's been on the job 3 years, and her daughter has a credit score of 676 now. And going through a lot of your conversations, some of this might have been answered, but can you answer that specifically?
Yes, absolutely. Depending, and I'm very tangible, Angela, so I'm just taking this scenario. Based on the scenario, I like to see everything firsthand. However, if all that you say is accurate, then the first-time home buyer, and if you live in Virginia or North Carolina or Maryland, we have to look specifically to your county or state for first-time home buyer programs that to see that she falls within the guidelines and see how much they're offering to assist her with down payment or assistance. Because with the $10,000, you're still going to need more money for either down payment or closing cost. So while you have enough, if you do have a program, I think you'll be in good shape. But again, I would have to see the program and get more specifics. But from a borrower standpoint, and she could get a gift, whether it's from you or another family member, she's a good profile for FHA or even a conventional loan, but an FHA loan because it's less money down with 3.5%. And the score is right there and a decent rate. So yes, she's pretty much ready to go, but she'll need more money to close, depending on what she's looking to purchase. So those are all factors that we have to take into consideration.
Now, Jackie Ells Walton asked the question, is Town Bank a House Charlotte approved lender?
Yes, I believe so, but I would have to look at that. That's something that you would have to call me on a sidebar and we'll have to look up for you to make sure. I don't want to jump out there and say yes, and I shouldn't have said it. I think so. I would rather that we look that up for you and make sure that it is a certainty.
Okay.
All right, so I'm going to condense some of this so we can move right along. The USDA ideal for borrowers with little to no money down. When we say little to no money down, there's no money down, but you still have your closing costs. So at USDA, if you get the seller to pay your closing costs, that's another option that you have. You know, loan requirements, loan limits are based on areas, but again, a great loan if you're purchasing a home that's USDA approved. Next slide, please. Next slide. Anything credit, next slide. Sean has already covered. Next. 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 Okay, so in this particular, let me just cover something on first-time home buyer programs, because you asked a question, Andrew. Their first-time home buyer programs are not universal. So they might do what might be in Charlotte, what might be in Roanoke, Virginia, or Richmond, Virginia, is going to be totally different than what might be in Fort Washington, Maryland. There might be all first-time home buyer programs, but the requirements and the guidelines are going to be different. So that's why we have to find out specifically what you as a borrower qualify for. Just to touch on student loans, and this is my last slide, so I'm going to wrap it up. Student loans, just because your student loans say deferment on your credit report doesn't mean that we're not going to add a payment. By law, we have to add a payment depending on what kind of loan you're using, whether it's FHA, Fannie Mae, or Freddie Mac. The great news is in the last few years, we've made headway with this where you could just use 0.5 of the balance. It used to be 1% of the balance, and that just destroys people's opportunity that have a lot of student loan. The good news is that you could also now use income-based programs as long as you have documentation to show that you're an income-based program and that payment will be small with respect to what the 0.5 or the 1% would be. So they've made a lot of gains in this area with student loans, but again, more reason to get with a loan officer and make sure if you have student loans that you qualify and not assume just because it says deferred, it's zero payment there. There's always going to be a payment. I just wanted to make sure I included that. Now, like anything else that has a process, particularly like purchasing a home, this is my last, and I always save this for last because the home buying don'ts is absolutely critical. All realtors and most mortgage bankers have seen this and experienced it. And it's critical, and I go through it, and it's actually in our loan package as well, because it's very important. Number one, do not change jobs, become self-employed, or quit your job. It just changes your qualifications. Don't do it. And if you're doing something and let's say you're changing jobs to make more money, absolutely. Nobody could hold that against you. I've closed loans with that, so that's the exception. But call the loan officer first and tell them what you're thinking about doing. Do not buy a car, truck, or van, or you may be living in it while you're in the process. It is absolutely critical that you do not go out and incur a $500, $600, $700 payment while you're processing for a mortgage. Number three, do not use charge cards excessively or let your accounts fall behind. You're in the process. A lot of people think because we pulled your credit's not going to be pulled again. Well, I'm here to tell you that a soft pull is pulled just about on everyone's credit the day or 2 days before closing throughout the industry, not exclusive to us, but throughout the industry. And that is important that you know that, because all of a sudden you've got all this debt on there and you're not qualifying. So don't do these to yourself. Number 4, do not spend money you have set aside for closing. Don't look to go to Cancun for the 3-day holiday and enjoy yourself and forget your whole mission and your dream was to get home ownership. That should be paramount. You could go take a great vacation after you own the home. Number 5, do not omit debts or liabilities from your loan application. We're going to find out, and we're here to help you, but we can't help you if we don't know all the facts. So it's critical that you tell us everything so we could, in advance, make sure that you're qualifying, and we find out later on the credit report that there's debts that we didn't include and then you don't qualify. Do not buy furniture. You know what? Furnish the house after you get it. Get the house. Do not originate any inquiries on your credit card. While Sean said these inquiries are not really a factor as far as your score, keep in mind inquiries mean that there's potential for debt. So an underwriter is going to look even further into your credit and want to know why those inquiries are there, and did you establish new debt that we have not included in your qualifications. Number 8, do not make large deposit without first checking with your loan officer. All large deposits in excess of $500 requires a letter of explanation and a paper trail where that money came from. So it's important that you just take it easy. And this one, it kind of goes in concert with the number 9. Do not change bank accounts or move money between accounts. Warren Buffett, you're not. Leave your accounts leave your money in the bank accounts you have. Send us all your bank statements so you don't have to move anything. We can put it together, but the whole idea is to keep everything simple. And lastly, do not, I repeat, do not co-sign a loan for anyone. Absolutely, absolutely critical. You know how siblings are, mom and dad. Hey, I need you to co-sign on this new car for us. We need this car or whatever. At one point, at this point in your life, you have to be a little bit selfish. You've had this dream for a while for home ownership. You know what? If you can help them after you get your house, you can help them. But right now, concern yourself about you. Take care of your business. All right? Please adhere to these, and you will find the process a seamless one. There's ways that you could close in 2 to 3 weeks. You don't have to sit there and allow this to be labor task on just going through the process. So anyway, thank you for your time. If you have any questions, be more than happy to answer any questions for you.
I got a hypothetical that
Yes,
goes to all of you in that, and that's assuming that you were doing fairly well in your life, and then all of a sudden you lose your job. You lost your job for several years, 2 to 3 years.
Yes.
You come back and you get another job, or even get your job back.
Right.
Now your credit score during that time you were out is going to take a hit.
Sure.
But now all of a sudden you are back and you're ready to get rolling again, and you want to buy a house. How is all that going to impact you going forward in terms of, will a loan officer like you, Mr. Jones, we're gonna look at this and say, well, you're a good guy, you're coming back, we're gonna just give you your house because you're just a good guy, or is the credit score gonna actually hold you back?
Right. Credit score is going to hold you back. There's no such thing. Look, I love all my customers. I love anybody I speak to, but the good guy factor has nothing to play with. Okay, you have to know that there's certain rules and guidelines, and those rules are applicable. So a couple things though that Mr. Johnson said. You came back and got your job. First thing, that's great, because just because you had an incident, it's called life. there's going to be some challenges. So yes, we could count the income, we could get you on track. With your credit, and that, again, that's why there's a pre-approval. It is important that the first thing you do after you get your job back on track, and now you have some resources coming in, how do I set myself up so I can purchase the home? Do not assume that you could just jump in there, couple paychecks, gift from the family, and you could purchase the home. Make sure that your credit is back in shape. Let me know. I have what is called a credit simulator. It works in concert with Sean's credit reporting agency, United One. Credit simulator allows us to look at your credit when I pull your credit and do a what if. So if, let's say your score is 580. Well, what if they paid this down? What if they paid this off? What if they got the creditor to eliminate this? Anyway, any circumstance. With all of those issues taken care of, I will give you a snapshot of what you have to do. And I'm not alone. This is not exclusive to us. Other lenders should be able to do this for you, and they should provide this for you so you know exactly what you're paying down. A lot of people think, oh, I'm paying stuff down. Well, do you know what to pay down? Do you know where you're going? Have a blueprint, have it set up so you know where you're going and you're not spending money for naught. You're spending money with the specific goal of getting to closing. So yes, it's very important that that we do that and we cover it. But yes, you have to start over from the credit standpoint, and you know sometimes it takes you a little longer to overcome what happened to you previously, and sometimes it's just a couple of months of just getting everything back on track because you fought your way through it while you had it. Again, it's called life and things happen to people. It's just how we address it.
Okay, now, the other thing is, are these slides, are you going to send us some slides that we can make them available to the attendees as well as the people that registered that didn't show up?
You know what, I have to, typically we can because some parts of our company allows, from a compliance standpoint, allows us to do that. And I'm pretty sure that you would be able to do that because I just got the approval for Fitz from Town Bank. So I'm going to say yes. I'm going to go out there and say, yes, you can, because I just got the approval to be able to do that because people have been asking for it and it's been in compliance, and compliance has given us the okay to release them. There's no fiduciary issues there that will hold us back.
I have one question.
Yes, ma'am.
Is there any rule on who you can purchase your home with? Your spouse, your parent, sibling, friend? I mean,
There's no rule specifically. It depends. For instance, if mom and dad owns a home and they want to help you, great rule. A lot of people don't know this. A lot of loan officers don't know this, that they could help you with the house. Let's say they have an FHA loan. They could help you purchase an FHA loan because there's a rule that allows mom, dad, or any relative to help you purchase a home FHA, that FHA will typically not allow them to have more than one home like VA, more than one primary residence. So yes, they can help you, but just regular purchase, friends could purchase together, as long as they're going to both occupy the house, because then it changes the dynamic a little on what is considered investor for one, what is a trailing spouse, what, who's occupying the property and so forth. So yeah, there's a couple of things that we would have to find out, but for the most part, as long as they're occupying the residence, anybody could purchase together. But while I'm saying that, it is critical that they understand that both FICO scores have to qualify. So folks will automatically think because one person has a great FICO score and the other one doesn't, that we could compensate with the good FICO score. We cannot. Each FICO score stands on their own merits.
And we got one final question in the Q&A
Sure.
from Jackie Edwards Walton. And she wants to know, how do you look at fixed accounts that will be paid in full within a year? And also, how do you look at new hire employment before? I don't know what comes after before.
Okay, so I'll take the latter. The new hire employment, it depends on your work history prior. So, you know, there's a myth that you just started a job last week and that could be held against you. Not really. I mean, if you were working previous to that for 2 years, you're fine. As long as you're not, you have to be careful here, as long as you're not declining in income. Okay, because, and you have to be careful if you didn't leave the last job in an unceremonious fashion. In other words, you didn't get fired, you didn't act a fool at the last job. You have to be careful, because when we send a verification of employment, they're gonna fill that out and they're gonna let us know this person, blah, 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 blah. Now, we shouldn't be looking, but there's character issues with repaying the mortgage. You know, underwriters are human too. So just keep that in play. But yes, you moving on to another job shouldn't hold you back. With regards to debts that are a year old, they will be counted against you. If the debt is 6 months or less and is typically the underwriter would like to see, if it's $100 or less, they usually don't take it into consideration, but they usually look like a car payment, 3 something or 5 something. And if it's impacting your qualifications, your debt to income ratio, I could tell you that I've closed a lot of loans with loans that were 6 months or 4 months or 5 months because it's expiring. Now, a revolving debt is different in that regard because it's revolving. You know, just because you're at 3,000, recently in the last few years, they've allowed revolving debt to be paid off as long as you close the account, because, you know, the borrower, and again, folks, loan officers and underwriters are not foolish. They know as well that you could go back out and jack that card back up, and they want to make sure that you're in good shape for purchasing the home and you don't have those issues that is holding you back with a big payment after purchasing your house.
What if the credit card company increases your line and sometimes they don't ask you? Because I have had that happen to me where, because I'm paying on time and I've had it for years,
Oh, sure.
my
sure.
next statement, suddenly they've given me a limit that I don't want.
But if your credit limit is extended, that's fine. It's just whether or not you use that limit while you're in the process of purchasing the home. Common sense, and sometimes common sense is not so common.
Well, I'm gonna turn it back over to the host, but this was remarkable information, folks. I just want to say great job, and we're going to expand it to some other folks. We got a recording here, and it was on Facebook Live, and so we'll give you some information about all of this. But really enjoyed this conversation.
Oh,
Thank you.
Our pleasure. Thank you, sir. Thank you to the Charlotte Post for allowing us to be here. And if we helped anybody at all, and if you need to ask any additional questions, any side questions, feel free to ask me, and anything with Sean. While Sean will take questions, anything usually comes through the credit bureau, comes through the lender, but he will answer questions if you called him. That's why he presented his information, because at the end of the day, we're here to help people.
That's right.
So thank you again, and we appreciate the Charlotte Post, and we appreciate everybody that enjoyed. Yvonne, thank you for participating, because your questions were absolutely brilliant, so we appreciate you.
Thank you.
Yvonne, I want to say I enjoyed it, and I got more out of this than I've gotten out of the last 10 I've listened to.
Well,
Thank you.
for that.
Aim to please.
You
All
and
of ours
Sean,
will be
yes.
like this.
Thank you.
All of ours will be like this. You will get something out of it
Yeah,
that you can.
Well,
that
that's
is
the
useful.
goal. We're not
And it's
we're not
good to
trying to
have
give
each
you.
of you in the house.
Right.
You
Well,
know?
that's the bottom line, because all the frills and all the nonsense, that's why sometimes you just have to be candid and cut to the chase
Right,
and let people know this is what you're working with, because the end game is folks getting their keys.
right.
That's the end game.
And so I really can't go on vacation if I'm buying a house.
No, sir.
That was
Can't go to
a-
Cancun.
You can if you have the money.
Buying a house, I'm going on vacation.
Only if you go to Virginia Beach.
And you know what? You'll be happy you did once you have your keys, and then you could go on a great vacation months down the road.
Right. I want to thank all of you, Town Bank, Yvonne, Siobhan, and Sean.
Thank you.
It's been a
Appreciate it.
pleasure. And
Thank you.
thank you to all that participated today. And be well.
All right, and the same to you guys. Be safe.
Be
Be
safe.
safe.
Bye-bye.
Bye-bye.
Bye now.
Oh,